Good day, students who are doing cost and management accounting. I will be doing this question on a very important topic to understand, which is the reconciliation, where we reconcile the budget with the actual information, where we'll be reconciling the profit that we budgeted with the actual profit, and we reconcile that through the analysis of the variance. So I will be doing a question 1 named Soda LTD, and this question was out of 26 marks, and I just want to go straight to the requirement, which is only one requirement, and the requirement is to complete the statement that reconciles the budgeted and the actual profit for product soda for November, and we are required to show the missing variance as set out in the next page. So it means in this question there was a template where we have to compile the reconciliation, and we're already given some figures, and all that we had to do was to complete the missing variance. It says you needn't write the reconciliation statement. Simply indicate the missing figures, show all your calculations clearly. So I will be ignorant of this part because I want to be able or to teach you how to do the reconciliation from scratch. So if you get hold of this question, then it will be easy because the template was already provided for you. However, I will be using the approach where we reconstruct the reconciliation from the beginning, where I do the budgeted income statement or profit, then after I reconcile that to be equal to the actual profit through the analysis of the variance. So now it says in this question 1 that a South African company named Soda LTD currently makes use of standard absorption costing system, meaning when they are compiling income statements, they take, or when they're calculating cost of production, they take into account the fixed cost as part and parcel of the production cost, as opposed to the marginal or direct system where the fixed cost is not taken into account in the calculation of the total cost of production. Now it says for planning and for control purposes, they are using the absorption costing system, standard absorption costing system. This costing system is now under review by the newly appointed cost accountant. He has started preparing a statement that reconciles the budgeted and actual profit of Soda LTD based on the information supplied below. He needs your help, however, to obtain the missing figures. The following budgeted data relate to the production of product soda for the month of November. The product gets manufactured by mixing two types of raw materials, and these materials are named So and another one is Da. Then obviously the names of the materials, they come from the name of the company, or the name of the company comes from the names of the material, which is Soda LTD, and the product being soda, or the name of the product come from the materials that are being used to make the product. Then the data that is provided to us, we have material, which is material So, and raw material input, which is Da, and meaning it requires 0.4 kgs to complete 1 unit of soda, and we also need 0.6 kgs of material Da to complete this unit, meaning this unit, as I said before, it needs these two types of material for it to be a complete product. And the material is bought, or the standard cost of material is at 6 Rand and 16 Rand per kg, meaning we normally buy material at 6 rand per kg regarding the material so, and we normally or usually buy material at 16 rand per kg whenever we buy it from our supplier. Then the total cost per unit of material so becomes 2 rand 40 cents and 9 rand 60 cents for DA, and the total of that becomes 12 rand, which is the 12 rand of the two materials. And the raw materials cost per kg of output is 12 rand 50 cents. So this also is another indication that 1 unit of a unit or 1 unit is equal to 1 kg. Then it says fixed manufacturing overhead per kg of output is 40 cents. So now the fixed overhead had been taken into account in the calculation of the standard cost per unit. As I mentioned to you before that this is an absorption costing system where fixed costs are taken into account in the calculation of production cost. Then after the standard cost per kg of output is 12 rand 90 cents. So this is our standard cost. Then we are given the budgeted information, and our budgeted data for product soda for the period below is as follows. We estimate to sell 72,000 units. However, production is estimated to be 70,000 units, and the units being the kgs of a material and being the kgs of a product which is manufactured through the kgs of material. So in this case our output is in kgs and our input of material is also in kgs. So now if we want to sell 72,000 kgs and production is 70,000, that means there must have been some kgs of inventory that were available, which means there must have been some opening inventory that existed from the previous period, and that opening inventory is the one that will also be part and parcel of the sales, but not part and parcel of the production. So if we can sell 72 yet we manufactured 70,000, meaning 2,000 of the inventory was available from the opening. So now that means we would have said opening plus production minus sales. This will give us closing. So we don't know if there will be closing or not, but the fact that we can sell 72,000, meaning 2,000 must have been an opening, and the production we know that it was 70,000, and sales will be 72,000 units. Then the rest is likely to be the closing inventory. However, I'll still wait for further information to analyze. Perhaps the calculations will change, but so far I can say that there was no opening units. Then we are provided further with the opening with the opening inventory, which is 25,800 rands, which is 2,000 opening units. As I exactly said, that opening must have been 2,000 units for us to sell more by 2,000 from what we have manufactured. Our selling price 22 rand, and our budgeted fixed overheads being 28,000 rands. Then after it says the fixed production overhead absorption rate, which is the predetermined overhead rate, is based on the budgeted number of kilograms produced. So now this 28,000 was estimated based on the production of the 70,000 that we see here. It was based on that. So the POR that was calculated as 40 cents was based on the production of that 70,000 rands. So we go to the next part. It says all inventories are valued at standard cost. I need to say take note of this. It's very important. If they tell us that it will be useful in further calculations when they say all inventories are valued at standard cost. I'll explain that a little bit later on in terms of why this sentence becomes very important. So let us proceed to the actual information. And the actual information says to us that we have our sales for the product soda, which is 71,000. We have our production as 69,000. Once again, if you look at the total sales units, it is greater than what we estimate to produce. So for us to be able to sell more than what we have produced, meaning there must have been some opening units. And those opening units will be the difference between our sales and our production. And those opening units will be 2,000 units, obviously. And now to go to the sentence that I said, it is very important to note where they said all inventory are valued at standard cost. Now we can see that we have 2,000 units of the opening inventory. So now remember that opening inventory is calculated at the cost of the production of the previous month, meaning whatever was the total cost to manufacture this inventory in the previous month or in the previous period, that cost of the previous period to manufacture this inventory becomes the cost of this opening inventory in the current period. So now if we are not provided or if we are not given the cost of the previous production period, therefore now we'll not be able to calculate the opening inventory cost when we do our reconciliation. Therefore now that means the cost of the actual opening inventory will be calculated at the standard cost, and we have seen that our standard cost per kg, which is per unit, is 12 rand 90 cents because all the inventories are valued at standard cost. So that was very important for this perspective or for this calculation. So we have our selling price being 23 rand. We have our fixed manufacturing overheads that were actually incurred as 27,800. And previously we had our budgeted fixed manufacturing overheads and they were 28,000. And the difference between the three will be definitely a favorable variant. So we proceed to the next part where we are given the cost that we incur to buy material. So, and the cost was 6 rand 50 cents, and also the cost to buy material down will be was 15 rand 80 cents actually incurred. And if we look previously we anticipated, or on standard we usually buy material so at 6 rand. However, we actually incurred 6 rand 50 cents, which is above the standard price of material. And we usually buy material down at 16 rand per kg. But the actual purchase cost that was incurred to buy material down was less than the standard price of 16 rand. So now that also is showing us the variance in terms of the material price variance. Then after we go to the input of raw material so and input of raw material down. So now these are the kgs that were introduced in the beginning of the production process, which is 29,900 kgs and 40,100 kgs that were introduced in the beginning of the process of production. So now in material that was issued to production will be 29,100 plus 40,100, 29,900 and 40,100, meaning our actual production will be 70,000 kgs, and this 70,000 kgs is also in units because we are producing a product that is in kgs and we are using kgs. So now this must have been the cages that were used into production. So now I just want to go a little bit back once again. We were told that, and I was a bit ignorant of this for a purpose. We were told that yield is 96%. So now if they tell you that yield is 96%, meaning whatever you introduce in the beginning of the process, and this topic honestly does link with what we call process costing. So now, meaning if we introduce material in the beginning of the process, what it will be yield, or the output, will be 96% of what we introduce in the beginning of the process. So now that's what the yield mean. Yield means is the output of production, meaning our production or output is 96% of what we introduce or what we started with in the beginning. And the reason why our yield will not be 100%, it is because of what we normally call in process costing normal loss. So now that means 4% of what we introduce, or 4% of what we start with, becomes a normal loss. Therefore now we only get an output, or we only get a yield of 96%. So now let me just explain this more in details in terms of writing it in a formula perspective. Meaning our production, in simple terms, or in a formula format, which is also called yield, is equal to input, meaning the cages that we start with, times this by 96%. Therefore now this will give us our yield, or our production in simple terms. Whatever we start with, which is our input, 4% of that becomes a loss, and 96% becomes the output number of units that will be completed in that period out of the input that you started with. So now in this scenario, it means if the examiner would have decided, they could have or have decided to also combine this topic with the process costing, because there is an element of normal loss. However, let me just put that aside. So far, perhaps it was important for somebody else to understand the principles of normal loss. So now this is the information that we have, a very short information. Then after, we are then now required to compile the statement that reconciles budgeted and the actual profit for products sold for the month of November. So now we are doing this only for the month of November, and it's very important to note that it's only for 1 month. And reading from the information that is provided here, there was no information regarding the month of October. And why am I emphasizing this is because we are given the actual information. And under our actual information, this actual information is only for the month of November. And I said that if we have the sales of 71,000 and the production of 69,000, meaning 2,000 is our opening inventory. And if 2,000 is our opening inventory, so now we need to ask ourselves, at what cost will this opening inventory be calculated at? Because this is the opening inventory in the month of November, but it was closing inventory in the month of December. So now this means the 2,000 units of the opening inventory were manufactured in the month of October, and we don't know the total production cost per unit for the month of October, so that we can multiply the cost per unit of October to the production closing inventory, or to the closing inventory of October, so that this becomes the opening cost in the month of November. So now, because we are not aware of the last month production cost per unit, therefore now that was the importance of this sentence, to say all inventories are valued at standard cost, meaning the opening inventory in the month of November will be calculated at the standard cost of 12 Rand 90 cents. I'm just highlighting and emphasizing on this because it is very crucial in this exercise. Hence, in the subject cost and management accounting, it becomes very crucial, if not significant, that one's read each and every sentence and each and every word very carefully, because one sentence or one phrase can change the entire scenario. And it's not always the case that all inventory, inclusive of the opening inventory, will be calculated or valued at standard cost. Rate based on the information that you are provided at that point in time. If we are given the cost of the previous month, please take the cost of the previous month and you value the inventory in the opening period that you are budgeting for. So now with that, let us do our reconciliation. And our reconciliation, we know that it is reconciliation statement where we reconcile the budget with the actual profit. Then we are doing reconciliation statement. Reconciliation statement, which is the reconciliation of budgeted with the actual profit. And we start with the budgeted profit. Whenever we reconcile budget and actual, we start with the budgeted profit. And we know that our budgeted profit or any profit start with the sales less our cost of sales. So now we have to look for the amount of sales, and I think our selling price was 22 rand per unit. Then we multiply the 22 rand per unit. We need now to go to the budgeted information because we are doing the budgeted profit. Our sales were budgeted to be 72,000 and the selling price per unit is 22 rand. There is the selling price per unit. We multiply those two, that will give us our budgeted selling price. So we say times this by 72,000 kgs or 72,000 units. 72,000 times this by 22 rand, it gives us 1,584,000 rands. This is 1,584,000 rands. This is our budgeted sales. Then we less our cost of sales, and I want to formalize it and write it as less cost of sales. Though sometimes in the solution they might not say minus or less cost of sales, but it's very important that you understand that we subtract our cost of sales. Then cost of sales is made of opening inventory plus production, and I want to say plus production. And our production will be made of material. And under material, we had two types of material, which was material saw and material da. So we can split the two, or we can just write it as one amount. And I just want to write it as one amount in this case, where we only have production, and our production will be just made of the cost, and also taking into account the opening inventory. We know that our opening inventory was calculated also as 2,000 units. I said that opening was 2,000, which was already given to us as 2,000. And they've already given us the opening inventory for products sold budgeted at 25,800. So for the opening, there is no problem. We can just write the opening as it is 25,800 rands. And our production, we know that our production cost per unit was given to us as 12 rand 90 cents. Remember, we are still on the budgeted information, where we use the standard information per unit to multiply to our production, because this is our budgeted production cost per unit, 12 rand 90 cents, which was made of the material, both of the materials, plus the 12.50 plus the 40 cents, that gave us the total cost. And be mindful of the fact that the 40 cents was our fixed overheads that was given to us per unit. Be mindful of that. And again, if we wanted, we could have still not included the opening, the fixed overheads of 40 cents, where we could have just taken the 12 rand 50 cents. Then after we have a separate line item saying fixed cost, and our fixed cost would have been recorded as budgeted at 28,000 rands, which is the 28,000 rands. So we already have the 40 cents of the fixed cost, and I want to also give you clarity on that. We have our 28,000 rands as our fixed cost, which we were told that it was based on the number of kilograms produced. Remember, our production budgeted was estimated at 70,000. Let me just erase and we get to see how much was our production. Remember, our production was estimated at 70,000, and it says the fixed production overheads absorption rate, which is POR, is based on the budgeted number of kgs produced, meaning they said 28,000, divide this by 70,000 units that we budgeted to manufacture, and that gave them 28,000 rands. Divide this by 70,000 rands. This was exactly 0.40. So now this 0.40 was calculated based on this production of 70,000. That is why now they had that 40 cents. It's exactly come from the production units of 70,000. So now, meaning if we take the amount of 12 rand 90 cents, meaning the fixed cost of 40 cents is already included in the production cost that we have budgeted. So now if fixed cost is already included, meaning there is no need for us to be taking into account fixed costs separately. So we can just say 12 rand 90 cents times this by the estimated production of 70,000, and this will give us our total production cost that we budgeted for the period of November. So this will be 12 rand 90 cents times this by 70,000, because we estimate to manufacture 70,000 units, and this gives us 903,000 rands. This gives us 903,000 rands. Now I also want to split this production into two things, into material and into fixed cost, because sometimes this question can be you can be given information differently. So if we wanted, once again, we could have said material, then after we say fixed cost, and we know that our fixed cost is 28,000 rands, and our total material cost per output or per unit would have been the cost before the 40 cents was accounted for. So now, meaning we have to take the amount before the fixed cost was taken into account if we want to split our fixed cost. So now, meaning we'll have to take the cost per unit, which is the variable cost per unit only, which is material, 12 rand 50 cents. Then after we have to say 12 rand 50 cents times this by 70,000 kgs. And also for material, if we wanted, we could have said 40 cents times this by 70,000, which is the same 28,000. So now if we say 12 rand 50 cents times this by 70,000, it gives us the total of 875,000 rands. And the total of the two is supposed to give us the same 903,000. And we say plus 28,000 rands. This gives us the same 903,000 rands. That's what I wanted to do previously when I said material. So this is just another way in which you can do this, or else you can just save only this one line item, or you can split it into two. And remember, there was no closing inventory. We can just say closing inventory or value of closing inventory. There was nothing under closing inventory. However, closing inventory would have been recorded as negative. And remember that closing inventory also would have formed part and parcel of the calculation of cost of sales, but we did not have the closing inventory. So now from here we can have our budgeted profit. We can now have our budgeted gross profit. and our budgeted gross profit will be the sales minus the cost of sales, and our cost of sales will be 903,000 plus 25,800, which is the opening inventory, which will give us 928,000 rands. 928,800 rands. Then we minus this from 1,854,000, 1,584,000, and this will be 655,200 rands. 655,200 rands. And this is our budgeted profit. And it's likely that our budgeted profit will not be the same as the actual profit because of the variance that we have to take into account. So now we have to calculate our variance, where we do the variance analysis. Variances. Our variances will start with the sales price variance. We start with the sales price variance. Our sales price, remember, we only had one product. So if there was one product, very easy. We take our actual selling price, which is 23 rand. We minus our budgeted selling price of 22 rand. And we multiply this by the actual sales, which means it's actual selling price minus budgeted selling price times that by the actual sales. And if I still remember, my budgeted selling price was 22 rand. There we can see the 22 rand. However, we start with the actual selling price was 23 rand. So we start with the actual, we minus the budget, then after we multiply that by the actual sales. This is the actual sales. Actual sales being 71,000, and this will give us the sales price. So now, meaning it will be 23 minus 22, times this by 71,000. We get 71,000, and our variance of 71,000 is very favorable because we sold our inventory at 23 rand instead of 22 rand that we estimated or anticipated to be. So now obviously if we are selling at a higher price than we budgeted, that will be increasing the revenue of the company and also the profit of the company. So now having higher revenue than we anticipated or expected means a positive variance or a positive thing for the company. So now always when it comes to the variance, start with the sales, which is the price. And if it's the price, you must have the price inside the brackets. Then you multiply outside by the units that were actually sold. At the same time, if we wanted, we could have used the other dimension of this variance, where now we take the actual sales of 23 rand, times this by 71,000, which was our actual sales. Then we minus the standard sales, and our standard sales will be 22 rand, times this by the actual sales units of 71,000. If you do this, it should give you almost, not almost, in fact, the same variance, which is our standard would have been 71, our actual would have been 21 times by 23, which will give us 1,633,000 rands. This is the actual sales revenue in total, and you minus the standard sales revenue. Remember, standard sales revenue is the actual sales units times that by the standard selling price, meaning you say how much revenue the company would have obtained if these units that were actually sold would have been sold at the selling price that was estimated to be 22 rand. So that's what the standard sales revenue means. We are taking the actual sales and we multiply them with the price that we estimated or budgeted or anticipated to sell our product with. Therefore, now that will be 22 standard selling price or budgeted selling price times this by 71,000 units that were actually sold. This gives us 1,562,000 rands. So this becomes the standard sales revenue. The standard sales revenue. And we say minus 1,633,000 rands. This gives us the same 71,000 rands as a favorable variance. Remember, you could have said this minus this, you get to the same variance. So now either way you calculate it, it does not matter as long you get to the same amount at the end of the day. So at least I've shown you now all the alternatives in which you can calculate the sales price variance. Then after we go to the sales volume variance. We go to the sales volume variance. We go to the sales volume variance. Volume is referring to the number of units. Sales volume variance. Remember the heading is variance, so even if I can just say sales volume. So my sales volume, I need to know how many units were actually sold. And I subtract the units that were budgeted to be sold, which is 72,000. Then I multiply this by the standard contribution per unit. And our standard contribution will be the 22 rand minus the 12 rand 90 cents. Minus the 12 rand 90 cents, which is my variable cost. So let us first confirm our budgeted and our actual sales. Our actual sales were anticipated at 71,000 and budgeted, or our actual sales were actually 71,000, not estimated, were actually 71,000, and our budgeted sales units were estimated at 72,000. Then after we have to multiply that by the standard contribution per unit, and remember the standard contribution per unit will be this budgeted selling price, which is 22 rand minus the variable costs. The variable cost or the cost per unit was 12 rand 90 cents. So now that will be what it means to multiply by the standard contribution. So now in this case we have to say 71,000 minus 72,000. So surely this variance will be unfavorable because we sold less than what we anticipated to sell. We times this by 22 minus 12 rand 90 cents. This gives us contribution of 9 rand 10 cents. So 9 rand 10 cents times this by 10,000. It gives us a total of 91,000 rands. This gives us a total of 91,000 rands. So this will be our variance of 91,000 rands. Let me just recalculate that. 71,000 minus 72,000. Oh, that is just 1,000, not 10,000. That is 1,000 times this by 9.10. It is 9,100. The 9.1 is adverse variance, negative variance, because we sold 71 instead of selling 72,000 units. So that will be 9.1, a variance that will be unfavorable. So now another variance that you would have to take into account will be the variance that we call sales mix variance. Sales mix. And we only do the sales mix where there are two products. If you only have one product, you will never have the sales mix. In this case, we only had one product. The product was called soda. Product soda. So now we only have one product. Therefore, now we will not have the sales mix. And if there are two products, make sure that you calculate your sales mix variance. Then after, we can go to the material variance, which is material price material price variance. And our material, we start with we have two materials. Take note, we have material saw and material dar. And material saw and material dar had the standard price per kg, and the standard price was 6 Rand and 16 Rand. Standard price per kg. And the standard price per kg, just to confirm that, it was 6 Rand per kg and 16 Rand per kg. So that's where that is coming from. Then now we need to check the actual price of material. How much did we buy material for per kg? The purchase cost per kg of raw material so was 650, while the purchase cost per kg of material dar was 15 Rand 80 cents. So these are the actual cost of material that we incur. So here we bought material at a higher price, and here we bought material at a lower price than we estimated. Times this by the actual quantities that were purchased. So now we need to go and look for the quantities that were purchased, and the actual quantities that were purchased are given to us as 29,000. If I still remember, it was 29,920 and 40,100 francs. There we have 29,900 and 40,100, which was material that was actually purchased, which is input of raw material 29 and 40,100. So now we have to multiply that to get to our variance. So now let us do that. 29,900 and 40,100. Term that by 29,100 and 40,100. This is the actual production of or actual material that we have purchased. So now in that we will be dealing with the variance of the material in terms of the price. Then that will be 6 minus 6.50, which is 50 cents, times this by 29,900. And this gives us an unfavorable variance of 14,950. We estimated to buy material at 6 Rand, but we bought it at a higher price, and these are the kgs that were bought. Then after we estimated to buy material at 16 Rand, but it was actually bought at 15 Rand 80 cents, that is favorable. 16 minus 15 Rand 80 cents. And this gives us 20 cents, term that by 40,100. And this will be 8,020. 8,020 was a favorable variance. Therefore, now we have to calculate the net of the two, which is minus 14,950. 14,950. This gives us the net of unfavorable variance as 6,930, which is adverse variance. This was adverse variance, unfavorable. Therefore, now the net of the two variance is 6,930, which is adverse variance. That was the price of material. That was the price of material. Then from here now we do the material mix. This is another variance that you need to be mindful of, that you only use material mix or calculate material mix only if you have two materials, which is material saw and material dar. In this case, we do have two materials. Therefore, now we can calculate our material mix variance. Then we have to subtract this from the actual cages that were bought, which is 29,900 and 40,100. Therefore, now I need to calculate my material mix. Now, material mix is calculated similar to the sales mix variance, where we say total material that was used into production was the sum of the two. Total material was 70,000. Material issued to production was 70,000, which is 29,900 plus 40,000 became 70,000. So now whenever you are doing a mix variance, you must take the actual in terms of material. You take the actual material used into production, which in this case is 70,000. Then after now, you allocate that using your standard kgs per unit. Your standard kgs per unit in this case is 0.4 and 0.6. And we know that 0.4 plus 0.6 will give us 1. So now our base of allocation will be 40% is to 60%, allocating the actual material using the standard kgs per unit, meaning the kgs that we anticipated will be used to mix in order to complete 1 unit of a product. So now calculating our standard material or material mix for product, so it will be 0.4 divided by 1. Remember, the 1 is 0.4 plus 0.6. Times this by 70,000 kgs. Therefore, now this will give us 0.4 divided by 1 will be 0.4. Times this by 70,000. This gives us the standard kgs or the standard mix as 28,000, meaning the kgs that were supposed to be mixed based on the standard information. Then after we go to product DA and you say 0.6, divide this by the total mix, standard mix. The total standard mix being 1. Remember, standard mix is 0.4 plus 0.6, which is 1. So the standard total mix is 1. Then hence we say 0.6 divided by 1. Then that gave us 0.6 times this by 70,000, which is actual material issued into the production process. Then this will be times 70,000. And it gives me 42,000 kgs of material. So now this will be 28,000 and 42,000. So now this is where the 28,000 fits in, and this is where the 42,000 fits in. Therefore, now we multiply this by the standard price per kg. And our standard price per kg was 6 Rand and 16 Rand. That was the standard price of material per kg, which is what we anticipated material will be bought at. And that was the 6 Rand and the 16 Rand that we can see here, 6 and the 16 Rand. Standard cost per kg. Therefore, now we can calculate our material mix variance. Always use the same method whenever you are dealing with a mix of material. Only it will be applicable if there are 2 types of material. If there's 1 type of material, don't ever calculate material mix because there's no mix. Times this by 6, it gives us 11,400 as adverse variance. 11,400, and this variance is adverse, meaning unfavorable. Then after our 42,000 minus 40,100 and times this by 16, it gives me 30,400 as a favorable variance. Therefore, now I can calculate the total of the 2 variance. Then minus 11,400, then the total will be 19,000 as a favorable variance. The net will be favorable because the bigger variance, which is 30,400, is favorable. So the net of the 2 will be favorable. This was material mix. Therefore, now we go to material yield variance. We go to material yield variance. Material yield. And material yield is also going to be for the two products. So and down. There will be a minus. Therefore, now under material yield, I will show you again how you deal with the material yield. And this question was a bit tricky, and it's very important that you take this also into consideration. That material yield is one of the variants that are just not easy to grab marks on. However, we still multiply this by the standard cost per kg, term that by the standard cost per kg. Sometimes we just need to keep the basics yield, keep the basics of the variance. So now we were told that our yield is 96%. We were told that our yield is 96%. So now, if our yield is 96%, that means that our output of production is 96% of what was introduced in the beginning of the process. So now, if we have our production as 69,000 kgs, meaning we said input, which we don't know the total of our input. We said our input times by 96%, it gave us the production of 69,000 kgs. That's what happened. We said input, term that by 96%. Why? Because 4% of what we introduce, or 4% of the kgs that we start with, becomes a normal loss. So now the output becomes 96% of what we introduce, meaning our output or our yield is 96% of the input. Therefore, the 4% is the normal loss. Hence, I said this topic can also be integrated with the process costing, where there will be a spoilage point and the normal loss and abnormal loss where necessary, depending to what the question is giving you. So now in this case, we are looking for the input, and the input that we are looking for is the input that was introduced, and that input came out as 69,000. So now we have to say divide here by 96%. And this will cancel this, and we do the same thing. We divide here by 0.96, which is 96%. So now our input will be 69,000, meaning unit that were introduced. 96,000 divided by 0.96, which is 96%. Sorry, 69,000 divided by 0.96. This gives us a total of 71,875. So now this is input allowed for output. This is input allowed for actual output. Input allowed for actual output. Actual output. Meaning you need, or the company needed, 71,875 units of material or kgs of material to start with, in order for the company to get an output of 69,000, which is given to us here as production, which is our output or our yield. So now we have to say how much were the total units that were introduced in the beginning. Therefore, now we get to see that we introduced a total of 71,875 units. That came up to the total of output of 69,000. So this was our input allowed for the actual output of 69,000 kgs. So now input allowed will be 40%, will be 4%, which is our standard cost. So now we need to know how much was supposed to be the input for product. So if the total input was 71,875, remember this 71,875 comes exactly from this calculation. So now if we have this, that means 71,875, which is total input for the two materials, which is material so and material down. Let me repeat that. This total input, which gave us an output of 69,000. This was the input for the two materials, because for every product we need two materials, material so and material down. So when we have this production of 69,000, meaning the kgs of material so, they are already included there, and also the kgs of material down, they are already included there. So now we know that we need to mix a total of 0.4 kgs per unit. So now we need to know how many total kgs of material so that must be allowed as input in order for the company to get the actual output of 69,000 units. And also how many kgs of a product of material down at 6 kg per unit must be introduced or started with in order for the company to obtain a total yield or total output of 69,000 units. So now meaning we times this by 0.4, then this will give us the input allowed for output of, then this becomes 28,750, and this will be for product so. Then we have 71,875 times this by 0.6, therefore now we need the input of 28,750 in order to yield the 69,000 units. Then we have 71,875 times this by 0.6, and it gives us 43,125. This is for material down. So now this is the input, which is 28,750 and 43,125, and we compare this with the standard yield or the standard input that will yield to the output of 69,000 units. So now we go to again the standard information. Now we have compared the input allowed for the actual yield. Input allowed for the actual yield. This is what we need. Therefore now this is the input allowed for actual yield. Therefore now we need to know the standard input. How much input was supposed to be introduced for us to get to the output of 69,000 kgs. Therefore now we know that units that were introduced, meaning units that were actually introduced, and I always say this, standard, anything that is standard, if it's standard production, standard kgs or standard yield, it has to do with the actual information. So now in this case we need to know our standard yield. Remember, what we just calculated is our actual yield. This is our actual yield, which was input allowed for the actual yield. In other words, this was, as I said, input allowed for the actual yield, actual input that was allowed for the actual yield, meaning what you must introduce or what was actually introduced for the company to obtain the actual 69,000 units that they manufactured. So now we need our standard input that was supposed to be the number of units to be started with for the company to yield the total of 69,000. So now meaning we have to say the actual material that went into the production process was 70,000, which is the actual material. Then we take the actual material, we multiply that by the standard kgs per unit, so that we get to the standard input allowed for the actual yield, meaning how many kgs were supposed to be the input in order for the company to get the output of 69,000. So that is what we call the standard input allowed for the actual yield. So our standard input allowed will be 0.4 times that by 70,000 and 0.6 times that by 70,000. 70,000 being the actual material that went into the production process. So for material sold, it will be 70,000 times this by 0.4, and for material done, it will be the same 70,000 times this by 0.6. So 40% of 70,000 will give us the standard material as 28,000 standard material, and this will be 70,000 times this by 0.6, which is 42,000 kgs, which is the kgs that were supposed to be the input in order to allow the company to get the output of 69,000. We have 28,000 and 42,000, and this will be 28,000 and 42,000, and this is exactly what we calculated previously. Exactly what we calculated previously in the material mix variance. Now we proceed to the calculations, and calculations will be 28,750 or 28,750 minus 28,000. This gives us 750, and 750 times this by 6, we get a total of 4,500 variance that is favorable. 4,500 of the variance that is favorable, and 43,125 minus 42,000, and this is 11,250 times this by 16. It gives us a total of 18,000 as the variance that is also favorable variance, and the total of the two will give us obviously a net of the favorable variance. Favorable, and the total will also be favorable. Plus 4,500, this is 22,500 rands, and this variance is favorable. So now we have touched based on the material, which is price, mix, and yield. And if we have touched on these two variants, meaning we are done with the material, then after we can now go to the next variance, if we do have the next variance. Remember, in this case, this company did not make mention of any usage of labor, where their labor cost or rate per hour or per unit. So labor is out of the picture, and also our overheads, which is variable overheads, they are not in the picture. The only overheads that we have is the fixed production overheads. So now this is the only last variance that is left, and we budgeted 28,000, but the actual fixed overhead was 27,800. So this will be a favorable variance. 28,000 budgeted minus 27,800 actually, then the difference of 200 will be a favorable variance. So let us have our fixed cost variance, fixed overheads variance, and our fixed overheads will be budgeted, and our budgeted was 28,000, and our actual was 27,800, and the variance is 200, as I have shown you. 200 favorable and 200 favorable variance will be the total. So that will be favorable and that will also be a favorable variance. So now we have captured that variance. Then we can go now to the next part, where we calculate the total and we determine if have we made a profit or a loss, or have we made a profit or a loss still after the variance. Then we compare that with the actual profit or a loss, and it has to reconcile at the end of the day. Therefore, now let me just start in the beginning. And in the beginning, this is where we started, just to check if is there any missing variance that I might have forgotten. Price, volume, there's no mix. Remember, under sales, there's no mix because only one product. Material, we have a price. Material, we have mix because there are two materials. If there are two materials, then you can have the mix. Yield, we do have our yield. It was given to us. Then after, we have also our fixed overheads variance. And under our fixed overhead variance, I also want to get more clarity on that, so that we check if there is no variance that we have mixed under our fixed overheads. We have calculated the 200 under fixed overhead. The one that we will need to do under fixed overhead is fixed overhead volume variance. Yes, under fixed, it will be fixed overhead volume variance. Fixed overhead volume variance. Fixed overhead. Fixed overheads volume variance. So under fixed overheads volume variance, which is the last variance now under fixed overhead, it is actual production units minus budgeted production units termed that by the standard fixed overhead rate. It is actual production minus budgeted production. Remember, we are referring to the units. Actual production units minus budgeted production units. I just want to write this one all because we don't normally do it, but when it's there, please make sure that you take it into account. Budgeted production units. We term this by the fixed overhead rate per unit, which is the standard fixed overhead rate. Overhead rate, fixed overhead rate, which is the POR, fixed overhead rate. And our fixed overhead rate, it was 40 cents. Standard fixed overhead rate standard. Fixed overhead rate standard, which is our standard fixed overhead rate. If you remember, our standard fixed overhead rate was given to us as 40 cents, and I calculated how we got to that standard fixed overhead rate. It was based on the number of kilograms produced. So hence now we take our budgeted, we compare that with our actual production, and we term this by the fixed overhead variance or fixed overhead standard. So now for space purpose, I just wrote it so that you can know what we subtract and what we add. We said that it will be our production, and our production will be actual production, and actual production was 69,000 units. Let me check our production. Our actual production was we have actual production units of or actual was 69,000. Our budgeted was 70,000. So we start with a budget of 70,000. We have 70,000 minus 69,000. Term this by 40 cents. Then after we see now our variance will be 70,000 minus 69,000, and we term that by 0.40, and this will give us a variance of 400. It will give us a variance of 400 rands. So that is the last variance that you need to take into consideration, and this is an unfavorable variance, adverse variance, 70, or preferable, let me just write it in the manner that will just make sense to everyone, where we have 70,000 here and we have 69,000, because you might wonder why is it positive yet it is unfavorable. So our budgeted was 70,000, but we ended up producing now 69,000. So if you want, you can say budgeted production minus actual, or you can say actual minus budgeted, as long you know the meaning of the variance, because in this case we wanted to manufacture 70,000. So now if we produce less than what we wanted, that is unfair for the company or unfavorable. Our production was estimated at 70,000. This is what we wanted to produce, 70,000. But we actually produced less than our estimate, which is actual was 69,000. So the variance will be unfavorable because the company is not meeting its budget in terms of production. So hence the variance is unfavorable. So this will be 400 of the variance that will be unfavorable in terms of fixed overhead volume. Sometimes they call it efficiency when they are using the number of labor hours, but they just gave us the absorption rate on the number of units, not based on the labor hours. So now I've captured all this variance, then I can start now calculating my actual profit. And calculating my actual profit, I will start with my budgeted gross profit, which was 655,200. Therefore, now I will have to say 655,200. 655,200 plus 71,000 minus 9,100, which was unfavorable, minus 6,930. Then after there was a 19,000 which was favorable, plus 19,000. Then there was 22,500 which was favorable, 22,500, and we had favorable 200 plus favorable 200 minus unfavorable 400 rands. Let me just reconfirm the figures. 655,200, yes, 71,000 plus minus 9.1 minus 6,930 plus 19,000, yes, plus 22,500, yes, plus 200, yes, minus 400, sorry for that. Then after this should give us the profit as 751,470. This should be actual profit. Or reconciled profit. Reconciled budgeted profit. So now we have to calculate our actual profit, and our actual profit should give us the same amount. Let me just use a different color, and this is just the closing. Then now I'm calculating my actual profit. Actual profit. My actual profit, I know that it must have the sales, and my sales were 23 Rand per unit, times this by 71,000 of the units that were sold. Then I have to subtract my cost of sales. I have to subtract my cost of sales, and my cost of sales will be made of the opening inventory, and my opening inventory, after we have to say plus the production, if you remember, plus production. And my production can be made of 2 materials and the closing. Then let us go and check our sales. Our sales were 23 Rand under actual. Remember, actual information, we are doing actual profit. 23 Rand times this by 71,000, so that is right. Then we have 71,000 units times that by 23 Rand, and it gives us 1,633,000 rands. My opening, remember, I think we had opening of 2,000 units, and I told you that all inventory is measured at standard, is valued at standard cost. And why did they say this? Just to emphasize once again, it is because we had our actual information, and our actual information, we had our sales that were greater than our production, where we produce 69 but we sell 71,000, meaning there must have been some opening, where we calculate that by opening plus production minus closing. That gives us sales, or let me say minus sales is equal to closing. Minus sales is equal to closing. So in this case, our production is 69,000 and our sales is 71,000, and we are not given the closing inventory. Closing inventory is 00. So now if this is closing units, there is no units of the closing. Therefore now if we can sell 71, meaning there must have been 2,000 that was there as opening units of inventory. That's why now we take that into account, but we don't know the cost price of these units, because opening units must have been manufactured in the month of October, because our actual information is for the month of November. So now closing inventory is opening inventory, sorry, is the closing of the previous period. I emphasize on that. So hence now there was the sentence that says all inventory is valued at standard cost, where they said all inventories are valued at standard cost, meaning our opening inventory must be valued at the standard cost of 12 Rand 90 cents, although this is actual inventory. Because of this sentence, therefore now we must value that at 12 Rand 90 cents. Unless stated otherwise, you will always do this. If they give you any information regarding the opening inventory, please take note of the information that will be provided to you. So in this case, I have 25,800 rands. And my production will be made of the 2 materials. My production will be made of the materials saw and done. And in this case, I have to split my materials. And I like this question because in the first scenario, everything was combined. In the second scenario, things now are split because I have a separate cost. Separate cost of 6 Rand 50 cents for material saw, and material saw was issued at 29,900 kgs. So I have to say the cost times by the kg that was issued into production. So for material saw, I will have to say 6 Rand 50 times this by 29,900 kgs that went through the process of production, which is 6 Rand 50 times this by 29,900, I get to the actual cost of material sold, which is 194,350. And material DA was actually bought at 15 rand 80 cents, times this by 40,100, which is the actual kgs that went into the process of production. That becomes the actual cost of material. And we can see that they provided that to us. It is there. Just change the color to see. We bought material DA at 15 rand 80 cents, and we issued 40,100 kgs. So we multiply these two, 15 rand 80 cents times that by 40,100, that gives us the actual cost. 40,100 times this by 15 rand 80 cents, it gives us 633 rand 580 cents. So our production in this case is made of the two materials, same as the previously, but we just split it because of the information provided to us. Then 194,350, 194,350 plus 633,000, 633,580. Then this will give us 827,930. Then there was opening, and don't forget that if there was closing, this would have been taken into account in this box where we say closing, but there was no closing in this case. So now we just say opening plus material 25,800 plus our total material. I get 853,750, 853,730. Just recalculate that, 25,800 plus 827,930, that is 853,730 minus 1,633,000. Let me, okay, one part that we need to account for is fixed cost. Don't forget, yeah, that's why it does not balance. Fixed cost, which is fixed overheads. Fixed overheads, and our fixed overheads are part and parcel of our production cost. Fixed overheads are part and parcel of the production cost. And our fixed overheads, let me check, it was 27,800 if I still remember. Yes, 27,800 was our actual fixed cost. There was the fixed cost 27,800. So this will be 27,800. So we have our production, which is made of the two materials, and the closing. Just take note of the production. Production cost. Then we now have to change our cost of sales, which will be 25,800 plus 827,930 plus 27,800, which gives 881,530. Check if that is correct. 1,633,000. That gives us the profit of 751,470, and you can say these two are right. Then I'm happy when it comes to that point. Yeah, guys, I try by all means to work things with you face to face. Sometimes I do make mistakes because I want to make sure that you understand that in practicing or in preparation, things, they don't just go perfectly at the beginning. You might have to go and recheck where you went wrong, what did you not take into account, analyze and refresh if was it the right way to calculate. You go back to the formula. So I'm doing all of this so that you can get used to the analysis of the question going up and down. So yeah, with this is what we are required to do at the reconciliation. Make sure that you reconcile the profit, which is this one, must be equal to actual profit. And there was a whole lot of things that we had to take into consideration. So now with this, I'm satisfied. Then I can say, guys, all the best. If you have any comments, please add your comments. If it's good comments, add them to the YouTube account. But if it's bad comment, just email me or check my details on LinkedIn or Facebook. Then after you contact me, then I'll respond to your comment. If you have any queries or clarity seeking questions, you need more clarity, you can still contact me in my LinkedIn. You definitely do have my details, name and surname. You get my details in LinkedIn and Facebook. Therefore now I can respond to you, or perhaps via WhatsApp after such. Then I can give you more clarity. Thank you, guys. God bless you. Amen.